On this channel, I mostly talk about how to analyze and research individual companies for motivated investors who want a way to be able to make a higher return than the market average. But in today's video, I want to talk about the best way that I think most people can invest for the people who don't have the time to analyze and research individual companies, but still want their money to work for them. Because let's face it, the 1% that you're currently earning in your savings account is not going to help you save for a house deposit or to reach your retirement goals early. Now, if you are one of my regular viewers who have a portfolio of individual businesses like myself, then this video is still 100% relevant to you, as I'm going to explain how I incorporate this strategy into my overall portfolio strategy, which for the most part you would be aware is made up of individual companies. So basically, if you're a living, breathing human and you plan to retire someday, then you definitely want to be watching this video all the way to the end. Now, before I explain why this works and how you can go step by step and use this strategy to compound your money exponentially, I want to explain and show you the difference between a person who is just saving money in a savings account, getting 1 or 2%, versus someone who is accessing the stock market and is able to exponentially compound their wealth by becoming a part owner in companies on the stock market. So let's go through an example and show you the comparison between someone earning 1% in a savings account and someone who is able to generate an 8% per annum return over a 35-year period, which is a very reasonable return to expect from the strategy that I'm going to show you later in this video. Now, in these examples, both of them will start with $5,000 invested at the beginning of their investment horizon. And then beyond that, for the next 35 years, they are going to be saving and setting aside $500 for investment. And of course, when it comes to the person who has a savings account, that $500 per month is simply going into a savings account that is generating a 1% return, which is generally approximately what you could expect from even a high interest savings account today. The other person is going to be saving that $500 per month, and then every quarter, so every 3 months, they are going to take the $1,500 and invest it into the stock market and generate an 8% return, which I will show you how you can easily do that later in the video. So we have one person, savings account, $500 every month, and the other person is $500 per month, but they're collecting it over every quarter and taking that $1,500 every quarter and investing it and generating an 8% return, both of them over a 35-year period. Now, of course, because both of them are saving the exact same amount, both of them are investing $215,000 over the 35-year period. So one person has put $215,000 into a savings account, the other one has put $215,000 into the stock market, generating an 8% return. And the difference between those two portfolios at the end of a 35-year period is staggering. So let's start with the person who had the savings account. So the person with the savings account earned interest of $43,600. That meant that their portfolio value after 35 years was approximately $258,600. Now, that seems like a lot. They did generate a decent amount of interest, but let's now have a look at the person who invested in the stock market and generated an 8% return. This person invested the same amount but generated approximately $1 million in interest. Yes, that is not a typo, $1 million in interest, leaving them with a portfolio of approximately $1.2 million after 35 years. So if you have never thought about investing in the stock market, if you're a young person in particular and you have never thought about investing in the stock market, that is exactly why you need to be investing in the stock market. Do you want $250,000 after 35 years of saving, or do you want $1.2 million in your portfolio? And 8% is not something that is some outrageous number that only the top 1% of investors achieve. So let me explain how you can make 8% even when you're investing in a recession like we are likely going to see over the next 12 months. Now, at this point, you are probably wondering why I chose to title this video How to Invest During a Recession, and the truth is that I really just titled it that because I know a lot of people are going to be searching that while all of these events are happening in the markets that have been happening recently. But the truth is that you do not need to invest differently during a recession. Whether the market is going up, whether it's going down, whether there's a recession, whether the market's doing well, whether the market's going sideways, it does not matter. Using this strategy, you can generate 8% by just following a very simple strategy that literally takes 5 minutes every single month. Now, this strategy is based on the fact that the US and Australian markets overall, broadly speaking, have gone up at a rate of somewhere between 6 and 13% per year over 100 years of data that we have. And that is not a coincidence that the Australian and US markets have done very well over the past 100 years. The reason why they have done well is because they are both very free market economies. They allow businesses to compete to produce the best products and services. And as a result, businesses spend trillions of dollars in order to make the best products and the cheapest products available for you guys. And as a result, during that process, they generate value, which generates profit, which makes their stock prices more valuable over time. Now, of course, at an individual business level, some businesses fail. Quite a lot of businesses fail, in fact. And some businesses succeed, and some businesses kind of just do okay. They never really grow over the long term. But if you bundle all of the businesses together, all of the biggest businesses in Australia or in the US, and you look over any significant length of time, they do very, very well because they are operating in a free market economy. So what is our strategy? Well, our strategy is exactly that. It is to bundle all of the businesses together. Don't be a part owner in one business or two businesses. Be a part owner in all of the businesses. And as a result, generate a return on average of the performance of all of those businesses, whether you're looking at the US market or the Australian market. And you might think that that is complicated, that you need to figure out what all of the different businesses are and go out and buy each of them, buy a little piece of each of them, but it's really not hard at all. There is an investment vehicle called an index fund, which is a fund that basically does all of the work for you. You buy a single stock, maybe two stocks in some circumstances, and then however much you invest is invested into little bits of the top, say, 300 or 500 businesses in that market. So if you're looking in the Australian market, for example, one of the index funds that I'm invested in is the Vanguard Australian Shares Index. That puts your money in the 300 biggest companies in the ASX. So you just buy that one stock, and by buying that one stock, you are investing in 300 companies, which, as we mentioned earlier, the ASX has gone up at somewhere between 6 and 13% on average when we're looking over a very long period of time. So let's now go through this step by step so that it is completely clear what you need to do. If you're a complete beginner, you have no idea what you're doing, this is exactly what you need to do. So step one is that you need to pick an amount of money that you're going to be setting aside every single month. So you need to sit down, look at your finances, look at how much income you're generating, look at what your expenses are, and figure out how much money you can afford to put aside and not touch for the next 10 years. So that bit is really important. It needs to be money that you are willing to forego for the next 10 years. Don't put money in there that you want to use for a holiday in 6 months or in 12 months or even in 3 years. Put money in there that you are willing to forego for 10 years. Think of it as saving for a house deposit or just building up your retirement fund. Step number 2 is that you need to pick an index fund that invests your money broadly in either the Australian or the US market. So, as I mentioned earlier, the index fund that I use as a proportion of my portfolio is the Vanguard Australian Shares Index. The ticker symbol is VAS on the ASX, and that one invests your money in the top 300 companies on the ASX. However, if you're in the US or somewhere else, then you can find one that invests your money in the S&P 500 or some other kind of index fund. There are a ton out there, and there's lots of different ones you can choose, but I think that the best option to go for is one that broadly invests your money in either the Australian or the US market. Now, to be clear, personally, because I'm very involved in the stock market, I am picking individual businesses, and about 80 to 85% of my portfolio is invested in individual businesses. But I still have about 15 to 20% of my portfolio invested in an index fund, and I use it as a foundation of my portfolio so that if my individual picks are incorrect or they turn out wrong, the foundation of my portfolio will still go up at around 8%, 6 to 10%, 6 to 13%. So if you are an individual stock picker, like most of the viewers on this channel, then it is still advisable that you could have a proportion of your portfolio in index funds as a foundation. But for the vast majority of people, for 95, 99% of people, just in the general population, an index fund is the way to go so that you don't need to spend time researching companies. You just buy everything. You don't pick the ones you think will outperform, you just buy everything, and on average, they have always done very well over long periods of time. And then step number 3 is that you need to pick an interval such as 3 months, 6 months, or 12 months, and every time that time comes up, you invest all of the money that you've been saving on a month-by-month basis. So in our example, the person was saving $500 a month, and then every 3 months, they were investing. So every 3 months, they have $1,500, $1,500 saved up, and they invest it into an index fund. Maybe it's the Vanguard Australian Shares Index Fund. So what you just need to do is put that interval, 3 months, 6 months, or 12 months, whatever it is, put that in your calendar, and every time it rolls around, you just invest, no matter what is happening in the markets. Is there a recession going on? You still invest if the time has come. It doesn't matter what is happening. If the market's good, if the market's down, if the market's sideways, you always do it. This strategy is called dollar cost averaging, and it turns out to be one of the best strategies in order to get an average price over the long term and get as close to the market average as possible, which is what we're trying to achieve. And then finally, the 4th step is that you want to be tracking the performance of your portfolio in some way so that you have an idea of what return you're generating in terms of the improvement in the stock prices of the businesses in your portfolio, in the index fund, as well as the dividends that you receive, the cash payments that you receive from that index fund that's coming from little bits and pieces from all of the 300 businesses in that index fund. And funnily enough, that leads us to talking about the sponsor for today's video, which is SHARESIGHT. So SHARESIGHT is a portfolio tracking software that I've personally been using for about 3 years since I started investing, and it is fantastic for keeping track of your capital gains, your dividends, your currency gains, and all of that stuff that you need to track how the performance of your portfolio has been over multiple years. SHARESIGHT also generates up to 10 different reports that can be used at tax time to easily work out your capital gains, your dividend income, and more. And you can try SHARESIGHT for free by using my link in the description below. It's the first link down there. You can try it for free, and if you decide that you want to sign up to a paid plan, you can use my link to get 2 months free when you sign up to a yearly subscription. So whether you're investing in individual businesses, index funds, or a combination of both, I think SHARESIGHT is a no-brainer for everyone. Try it out for free via the link below, and of course you can get that special deal, 2 months free, if you sign up for a yearly subscription. But I hope you guys enjoyed today's video, and if you have any questions, then make sure you go down to the comment section and leave them down there, and I will be answering your questions as this video goes live. But for now, guys, I hope you have a great day, and I'll see you in the next one.